Gold just crossed $500 an ounce, and Wall Street is stunned. Just 2 years ago, the very same gold ounce cost $2,000. Gold more than doubling in just 2 years is historically extraordinary territory. This price move is not a random spike or pure speculation. This is the largest sustained gold rally in modern financial history. The World Gold Council confirmed central banks bought over 1,000 tons annually. This buying was maintained at that extraordinary volume for 3 consecutive years. Gold buying at that level was last seen back in 1967. China, Russia, India, and Poland are all adding gold aggressively now. When the world's most powerful institutions move like this, everyone should notice. If this channel is adding real value, subscribe to Finance Insight now. Hit the notification bell so you never miss critical financial updates again. Now back to the numbers, because what they reveal is astonishing. To understand why gold crossed $500, the starting point is the dollar. The US dollar index recently fell to its lowest point since 2022. Gold and the dollar have a powerful inverse relationship throughout economic history. When the dollar weakens, gold almost always rises sharply in value. But what is driving this specific dollar weakness goes much deeper still. China has been actively selling US Treasury bonds at a record pace. China's US Treasury holdings dropped to $682 billion, the lowest since 2008. That figure is down roughly 10% from just 1 year ago. China now holds just 2% of total US Treasury bonds outstanding. That money is being redirected almost entirely into physical gold reserves worldwide. The People's Bank of China has been quietly loading up on gold. This is not just a portfolio shift. This is a strategic signal. Beijing is preparing for a world where the dollar matters far less. That preparation involves accumulating the one asset no government can print: gold. Gold cannot be printed, created out of thin air, or digitally manufactured. That scarcity is precisely why gold rises when trust in currencies falls. And right now, trust in the US dollar is under significant stress. The Bloomberg Dollar Spot Index recently fell to a 4-year low. Dollar weakness like this has deep structural and long-term economic causes. America currently carries a federal debt burden surpassing $38 trillion in total. U.S. annual deficit spending consistently exceeds revenues by over $1 trillion. That level of fiscal pressure is deeply damaging to long-term dollar confidence. Gold historically performs best when governments run persistent and unsustainable fiscal deficits. That is exactly the environment the United States is operating in today. But the dollar story is only one piece of the larger picture. Geopolitical fractures between major powers are accelerating the demand for gold globally. U.S.-China trade tensions and U.S.-Canada tariff wars are fueling gold demand. When geopolitical uncertainty spikes, gold is the universal safe haven asset of choice. Every major conflict and financial crisis in history has proven that truth. U.S. tariffs on China reached an effective rate of 31.6%. Canada retaliated with $30 billion in direct tariffs on American goods immediately. Japan committed $550 billion in U.S. investments to avoid steeper tariff penalties. Every one of these trade fractures adds fuel to the gold fire. Trade uncertainty slows growth and consistently pushes capital towards safe haven assets. Gold has served as the ultimate safe haven for over 5,000 years. No other asset on Earth carries that kind of historical track record. Now look at what central banks specifically have been doing in detail. In 2024, net central bank gold purchases reached an enormous 1,045 tons. 3 consecutive years of over 1,000 tons. That is unprecedented buying velocity. Nothing like this central bank gold accumulation has been seen since 1971. In 1971, the global monetary system underwent its most fundamental structural reset. That was when President Nixon ended the dollar's convertibility to gold entirely. After 1971, every major global currency became backed by nothing but trust. When trust in that fiat system erodes, gold always reasserts its dominance. Right now, that erosion is happening faster than most investors currently realize. Gold achieved over 50 all-time record highs throughout 2285 alone. Extraordinary momentum. No year in gold's entire modern trading history has matched that pace. The price trajectory of gold over the past 2 years is extraordinary. Gold hovered near $2,000 per ounce throughout most of early 2023. It crossed $3,000 for the first time ever in March of 2025. Then it crossed $4,000 and kept climbing without any meaningful pause whatsoever. By January 2026, gold crossed $5,000 per ounce for the first time. By April 2026, it climbed further still, crossing $5,100 per ounce. Gold had gained over 155% in value within just 30 months. The S&P 500 significantly underperformed gold over that same exact time period. Stocks have been volatile, unpredictable, and deeply rattled by tariff policy uncertainty. Gold, by contrast, has moved in one consistent and powerful direction, upward. The divergence between stocks and gold is itself a powerful market signal. It signals that something fundamental in the global financial system is shifting. When institutions and retail investors both rush to gold together, pay attention. Goldman Sachs revised its gold price target to $4,500 during 2025. Gold blew straight past that $4,500 target and kept climbing relentlessly higher. Goldman has since raised its gold targets multiple times, each quickly surpassed. Even the smartest institutions keep underestimating gold's momentum. That is significant. Now look beyond institutions and examine what retail investors have been doing. Gold ETF inflows surged significantly throughout 2024 and into early 2025. Retail demand for physical gold coins and bars also rose sharply worldwide. American investors who once ignored gold are now actively allocating toward it. Late cycle retail gold buying like this has always proven historically significant. The gold fear trade is no longer driven by institutions alone now. Mainstream investors are now reaching the same conclusion smart money already made. Convergence of institutional and retail demand creates powerful and sustained price momentum. Silver prices have also spiked sharply, confirming gold's broader momentum signal. Silver tends to lag gold slightly before catching up explosively in rallies. Silver also hit record prices in 2025, reinforcing the precious metals signal. Both metals rising in tandem always signals genuine systemic economic pressure. Here is what mainstream financial media consistently refuses to discuss about gold. The dollar's share of global reserves has fallen from 71% to 57%. The dollar dominance is fading, and gold is filling the vacuum left. The euro, yuan, and gold are all rising to fill that vacuum. This de-dollarization trend has been building for years and is accelerating rapidly. Gold at $5,100 is the financial world's loudest vote of no confidence. Gold is saying the current financial order is quietly but surely fracturing. Central banks, the most informed institutions on earth, are responding accordingly. Their buying actions tell a story every serious investor needs to understand. That story is not simply about gold. It reveals what comes next. The forces driving gold to $5,100 are still building, not yet stopping. The forces driving gold higher are structural, not temporary or speculative. Understanding those forces means understanding exactly where this gold rally ultimately goes. Start with inflation expectations, because they are the engine behind everything now. The University of Michigan survey showed one-year inflation expectations hitting 6.7%. That is the highest short-term inflation expectation recorded since the year 1981. 5-year inflation expectations from the same survey jumped to 4.4%. Those long-term numbers haven't been this elevated since the early 1990s. When inflation expectations rise, the real return on cash and bonds falls. When real returns fall, gold becomes dramatically more attractive as a holding. This is the mathematical relationship that drives institutional gold allocation every cycle. Gold has no yield, but neither does cash when inflation runs hot. At 6.7% expected inflation, holding cash means losing purchasing power rapidly. Gold preserves purchasing power over time better than any other known asset. History confirms this across every major inflationary episode in modern economic history. In the 1970s, stagflation era, gold rose over 2,000% in total. Investors who held gold through that decade emerged extraordinarily wealthy on the other side. Investors who held cash or long-term bonds were financially devastated by inflation. The choice between gold and cash is ultimately a bet on confidence. Confidence in governments, central banks, and the long-term value of paper currency. Right now, that confidence is measurably declining across multiple independent data sources. The Federal Reserve finds itself in its most difficult policy position in decades. Cutting interest rates would risk igniting the inflation expectations already running dangerously hot. Raising rates would risk crushing the already fragile consumer and business confidence entirely. Jerome Powell publicly acknowledged navigating this environment presents uniquely difficult challenges for policymakers. When the Fed chairman admits difficulty publicly, the underlying problem is always worse. Gold rises precisely in environments where the central bank has no clean exit. This is that environment, and gold is responding exactly as history predicted. Now look at the geopolitical dimension, because it is equally critical to understand. Russia's central bank has been accumulating gold aggressively since Western sanctions were imposed. Russia now holds one of the largest gold reserves among all central banks. Gold allowed Russia to partially insulate its economy from dollar-denominated financial sanctions. Other nations observed this carefully and drew their own strategic conclusions quickly. Countries now worried about future sanctions are quietly accelerating their own gold purchases. Turkey dramatically increased its gold reserves throughout 2024 and into early 2025. India surpassed its own historical gold reserve records during the same period. Poland became Europe's most aggressive central bank gold buyer throughout 2024. These are not economically connected nations acting on the same market signal. They are geopolitically diverse nations acting on the same strategic survival instinct. Gold is becoming the neutral reserve asset in a fractured geopolitical world. When trust between nations erodes, gold fills the space that trust once occupied. The BRICS nations have actively discussed creating a gold-backed trade settlement system. That discussion alone sent a powerful signal across global currency and commodity markets. A gold-backed settlement system would structurally increase gold demand far beyond current levels. Even the possibility of such a system is already influencing central bank behavior. Gold at $5,100 is partially pricing in the probability that this happens. Now consider what the mining supply side of gold reveals about this rally. Global gold mine production has been essentially flat for almost an entire decade. The world is not finding and producing meaningfully more gold each passing year. New large-scale gold discoveries have become increasingly rare and expensive to develop. Average gold mine development now takes 10 to 20 years from discovery to production. Supply cannot respond quickly to a demand surge the way manufactured goods can. When demand surges and supply cannot respond, price has only one direction to move. This supply constraint is a critical and often overlooked pillar of the gold rally. Even if gold demand stabilized tomorrow, supply constraints would keep prices elevated for years. Demand is not stabilizing. It is accelerating from multiple directions simultaneously right now. Physical gold demand from Asian consumers also reached record levels throughout 2024 and 2025. China and India together represent the world's two largest physical gold consumer markets. Chinese consumer gold demand surged as the domestic real estate sector collapsed dramatically. When Chinese property, historically the dominant savings vehicle, stopped delivering returns, gold replaced it. Hundreds of millions of Chinese savers redirected wealth from property into physical gold. That demand shift alone has structural multi-year implications for global gold pricing. Indian wedding season demand and cultural gold buying also hit record levels in 2025. These consumer demand pillars exist independently of the institutional and geopolitical drivers. Multiple independent demand sources all pushing simultaneously creates an extraordinarily powerful price dynamic. This multi-source demand environment is what makes this gold rally fundamentally different. Previous gold rallies were typically driven by one or two primary factors. This rally is being driven by at least 6 simultaneous and reinforcing factors: dollar weakness, inflation expectations, central bank buying, geopolitical fracture, supply constraints, and consumer demand. When 6 major demand drivers converge on a single asset, price reacts accordingly. Gold at $5,100 is not a bubble. It is a multi-factor convergence. Bubbles are driven by speculation and euphoria disconnected from fundamental economic reality. This gold rally is deeply connected to verifiable, measurable, real-world economic forces. Now the critical question every investor watching this needs to honestly answer themselves. What does smart money actually do when gold crosses $5,100 per ounce? The answer requires separating emotional reaction from strategic, evidence-based financial thinking. Smart money does not chase gold at record highs out of pure fear. Smart money had already positioned in gold when prices were far lower. The institutions that bought at $2,000 are now holding through $5,100 comfortably. For investors entering now, the relevant question is about the long-term trajectory. Goldman Sachs, JP Morgan, and UBS all maintain bullish gold outlooks beyond current prices. Goldman's most recent projections suggest gold could test $4,500 to $5,000 targets. Those targets have already been exceeded, suggesting even current analyst models lag reality. The structural forces driving gold are not disappearing in weeks or months. De-dollarization takes years to unfold fully. Geopolitical realignment takes years to resolve. Inflation psychology, once embedded, takes years of disciplined policy to extinguish completely. All of these structural forces remain firmly in place throughout the foreseeable future. Smart money is not selling gold at $5,100. That is the loudest signal. The investors who missed gold at $2,000 should not repeat that mistake again. Gold is not just a trade. It is a verdict on the financial system. That verdict at $5,100 says the system is under stress that is deepening. Every ordinary investor watching this needs to seriously examine their own financial exposure. An allocation to gold of 10 to 15% is now considered standard by serious analysts. That allocation is not about getting rich. It is about protecting existing wealth. Protecting wealth during a monetary and geopolitical transition is the smart money priority. Gold at $5,100 is the market's most honest, loudest, and clearest possible warning. If Finance Insight is delivering real value, subscribe and hit the notification bell. Drop your biggest gold question in the comments. The team reads every single one.